Hey everyone, welcome back to the channel. Today, we're diving into the fascinating world of trading markets. Whether you're completely new to this or just looking to brush up on your knowledge, this video is for you. We'll explore the main types of markets: stock, forex, commodities, and crypto. Understanding how each market works is crucial for any aspiring trader or investor. So buckle up, grab your notebooks, and let's get started. First up, let's talk about the stock market. It's probably the one you hear about the most, and for good reason. The stock market is where companies go to raise capital by issuing shares, which represent ownership in the company. Think of it like buying a tiny piece of your favorite company. You can buy shares of companies like Apple, Tesla, or even your local coffee shop if they're publicly traded. Now, the price of a stock is determined by supply and demand. When more people want to buy a stock, the price goes up. When more people want to sell, the price goes down. It's all about those basic economics, guys. But what drives that supply and demand? Well, it's a combination of factors. Company performance is a big one. If a company is killing it, beating earnings expectations and innovating, investors get excited, and the stock price tends to rise. On the flip side, if a company is struggling, missing targets, or facing some bad press, investors might get spooked, and the stock price could take a hit. Then you've got broader economic factors like interest rates, inflation, and even political events. All of these things can impact investor sentiment and ultimately move the markets. Now, there are two main ways to make money in the stock market: dividends and capital appreciation. Dividends are like little bonuses companies pay out to their shareholders, usually quarterly. It's a way for companies to share their profits with the people who own a piece of the business. Capital appreciation, on the other hand, is simply the increase in the value of your shares over time. You buy low, hopefully, and sell high, pocketing the difference. Of course, it's important to remember that the stock market is inherently risky. Prices can go down as well as up, and there's always the potential to lose money. That's why it's crucial to do your research, invest in companies you understand, and never invest more than you can afford to lose. Don't go chasing those get-rich-quick schemes you see online. Building wealth in the stock market takes time, patience, and a solid understanding of how it all works. Next up, we're diving into the world of Forex, also known as the foreign exchange market. This is where currencies are traded against each other. Think of it like a giant global marketplace where you can exchange one currency for another. Now, the Forex market is absolutely massive, guys. It's the largest and most liquid financial market in the world, with trillions of dollars changing hands every single day. That's right, trillions with a T. In Forex, currencies are traded in pairs. The most popular pair is the EUR-USD, which represents the exchange rate between the euro and the US dollar. Other popular pairs include the USD-JPY, US dollar, Japanese yen, GBP-USD, British pound, US dollar, and USD-CHF, US dollar, Swiss franc. So, how do you make money in Forex? Well, traders aim to profit from the fluctuations in exchange rates. For example, let's say you think the euro is going to strengthen against the US dollar. You would buy the EUR-USD pair. If the euro does indeed go up in value relative to the dollar, you could then sell your position for a profit. Of course, it works both ways. If you think the euro is going to weaken against the dollar, you would sell the EUR-USD pair. If your prediction is correct, you'd buy back the pair at a lower price, pocketing the difference. Forex trading is all about speculation and trying to predict which way the currencies will move. Traders use a variety of tools and strategies to analyze the markets and make informed trading decisions. One of the key things to understand about Forex is leverage. Leverage allows traders to control larger positions with a smaller amount of capital. For example, with 100-to-1 leverage, you could control a $100,000 position with just $1,000 in your account. Leverage can amplify your profits, but it can also magnify your losses. That's why it's crucial to use leverage responsibly and have a solid risk management plan in place. The Forex market is open 24 hours a day, 5 days a week, making it a popular choice for traders all over the world. But remember, it's a highly volatile market, and it's important to understand the risks involved before you jump in. Now let's move on to the commodities market. This is where raw materials and agricultural products are traded. We're talking about things like gold, oil, natural gas, wheat, corn, coffee, and even livestock, basically the stuff that keeps the world running. Commodities are essential to our everyday lives. We need oil and gas for energy, gold and silver for jewelry and electronics, and agricultural products to, well, eat. And because these things are so fundamental, the commodities market is heavily influenced by supply and demand dynamics. For example, let's say there's a drought in a major coffee-producing region. That decrease in supply could lead to a surge in coffee prices. Or, if there's a breakthrough in renewable energy technology, that could potentially decrease the demand for oil, leading to lower oil prices. Traders in the commodities market aim to profit from these price fluctuations, just like in the stock and Forex markets. They might buy low when they believe a commodity is undervalued and sell high when they believe it's overvalued. There are a few different ways to trade commodities. You can trade futures contracts, which are agreements to buy or sell a specific quantity of a commodity at a predetermined price and date in the future. You can also trade options on commodities, which give you the right, but not the obligation, to buy or sell a commodity at a specific price within a certain time frame. Another way to get exposure to commodities is through ETFs, or exchange-traded funds. These are investment funds that track the performance of a particular commodity or basket of commodities. Investing in commodities can be a good way to diversify your portfolio and potentially hedge against inflation. However, it's important to remember that commodity prices can be volatile, and like any investment, there are risks involved. Finally, let's talk about the crypto market, the new kid on the block that's been making waves in the financial world. Cryptocurrencies are digital or virtual currencies that use cryptography for security. The most well-known cryptocurrency is Bitcoin, but there are thousands of others, each with its own unique features and use cases. Some other popular cryptocurrencies include Ethereum, Binance Coin, Solana, and Cardano. One of the key things that sets cryptocurrencies apart is that they operate on decentralized networks called blockchains. A blockchain is essentially a digital ledger of transactions that is distributed across a network of computers. This means that no single entity, like a government or financial institution, controls the cryptocurrency. This decentralization is a big part of the appeal of cryptocurrencies for many people. They see it as a way to take control of their finances and opt out of the traditional financial system. Now, the crypto market is known for its volatility. Prices can swing wildly up and down, even within a single day. This volatility can create opportunities for traders to profit, but it also means that investing in cryptocurrencies carries a high level of risk. There are a few different ways to invest in cryptocurrencies. You can buy and hold, which is exactly what it sounds like. You buy a certain amount of a cryptocurrency and hold on to it, hoping that its value will increase over time. You can also trade cryptocurrencies on exchanges, just like you would trade stocks or Forex. This involves buying and selling cryptocurrencies with the goal of profiting from the price movements. Cryptocurrencies are still a relatively new asset class, and the market is constantly evolving. It's important to do your research, understand the risks involved, and never invest more than you can afford to lose. But with that said, the crypto market is an exciting space with the potential to revolutionize the way we think about money and finance. That's it for today's video on the different types of trading markets. We've covered a lot of ground, from the stock market to the exciting world of cryptocurrencies. Remember, the key to success in any of these markets is knowledge, patience, and a solid understanding of the risks involved. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more informative content. Your support helps the channel grow, and it allows me to keep creating valuable content for you guys. Leave a comment below if you have any questions or topics you'd like us to cover next. I'm always open to suggestions, and I love hearing from you guys. Until next time, happy investing.